This is probably one of the most important videos that I've watched in 2023. To everyone's surprise, it's not about inflation, it's not about the Fed funds rate, it's not about what Jerome Powell is doing, it's not about the US-China tension, it's also not about artificial intelligence. This whole conversation between the Millennial Investing podcast and also Aswaf Damodaran, the Dean of Valuation and somebody that I respect a lot, this conversation alone digs deep into your own personal, fundamental, underlying core investment philosophy. If you don't have a philosophy, then I don't know exactly what kind of plan or what kind of execution you are basing your investment decision on. Is it based on feelings? Is it based on I don't know, your gut feel or whatnot? This really elucidates, or this shed a lot of light personally for me. And I think this particular 12-minute clip, 10 to 12-minute clip, is going to be life-changing for both new and also seasoned investors, because it goes back to the basics of investing philosophy. So let's jump right into it. And of course, before that, remember to help smash that cute little like button.
Well, you have educated and inspired so many people in valuation. And what's also super interesting is, for our listeners who don't follow you yet, you also make public all of your analysis and your thinking and stock picks. And so it's just really incredibly informative and insightful to read those. You've been doing this for so long. I am wondering, who has influenced your personal.
So for those of you who don't know him, he actually does have a YouTube channel. You just search his, I think, first name, Damodaran. He actually made public all his lectures in NYU. I believe he's teaching there as a professor. He makes it public from, I think, first week to 13th or 16th week. And for those of you who didn't go through finance school before, trust me, I've just completed my finance degree. Largely speaking, whatever that you need, practical calculations, the theoretical advantages that you think undergraduate or somebody that have went through university or business school should have, everything is made public in his YouTube channel, and it's largely the same. There might be kinks and nuances in terms of the delivery and the teaching between different professors, but yes, for those of you who want a finance or business or investing 101 course, it's made free on his YouTube channel. But do take note, it might be a little bit technical. So for those of you who don't have prior background, you might need to do a little bit more digging and Googling. But yes, he made it public. This guy is just probably a saint or something. He's providing free education and a free $30,000-$40,000 qualification online in the online domain. But yeah, let's go ahead to listen to what he has to say.
Investing strategy the most?
I don't think it's a single person. It's a collection of people, because I think one of the mistakes we make is we put human beings on pedestals and we want to be just like them. And I'll give you the perfect example, Warren Buffett, an incredible investor, but people sometimes forget that he's human. He has his blind spots. And if you do exactly what he does, I'm not sure you'll deliver the results he got in the 1960s or 70s or the results in the last 20 years. I think what you need to do is take what other people do, take what parts of what they do that work for you, and then create your own philosophy that works for you as a person. So it's a lesson I actually teach in one of my classes, in investment philosophies class, where I say the right investment philosophy is the one that fits you, not the one that fits Warren Buffett or Peter Lynch or some other great investor in the past. Now, to be a successful investor, the person you have to understand is yourself. You have to understand your strong points, your weak points, what triggers you, what doesn't trigger you, and then create an investment philosophy that matches your psychology and your personal makeup as a person. So spend some time knowing who you are as a person, because that's a critical part of becoming a more successful investor.
So I think I cannot put this across any better. The entire investment journey is a personal one. It's a self-discovery process, if I can put it that way. And of course, I know that many of you out here, as males, you guys might be distracted along the way by shiny objects and also maybe the lady in this video. But I think I just wanted to kind of ground you guys in the perspective that there really is no right answer. There's no right way of investing. A lot of people have been commenting that, oh, Chee Keng, why are you not looking at technicals? Why have you tried before day trading and stuff like that? It's not that I don't believe in them. I do believe that there is many roads that lead to Rome. But personally, I've been in this journey, or I've been in this stock picking business, if you can put it that way. I do feel that I have the ability to stomach volatility. I'm fine with concentrating my portfolio, and I've been doing fine for the last 2 years, despite having a concentrated position. But that said, that's only for myself. You definitely shouldn't just model after me or model after any YouTuber or finance YouTubers of any sort. You have to find the only way that works for you. So just to provide more color, and of course, the other part about this whole idea of value investing, personal philosophy and strategy. Let's look into it.
I think it's so interesting because we often spend a lot of time studying super investors and we want to learn from their strategies and kind of emulate them ourselves. But I guess, where do you think investors go wrong when they just maybe copy someone's strategy like Warren Buffett? And where could they improve on that themselves?
Because first, the strategies that those people succeeded with were in a different market in a different time. What worked for Ben Graham in the 1940s and 50s, when he ran those 12 screens, worked because in those days, to run his 12 screens, you had to collect the data by hand from annual reports that were really difficult to get to, and compute the ratios with a pencil and not even a calculator, right? I mean, it's a slide rule or whatever he had to use. Computing those 12 ratios that he needed to screen companies was an incredibly difficult thing to do. It took weeks to do, which gave him a competitive advantage because most people were unable to do it. Those days are done. If you took what Ben Graham did in the 40s and 50s and try it today, when you can run the Graham screens in a millisecond online, what makes you think you're going to walk away with Graham-like returns? Same thing with Buffett. Buffett's most incredible successes happened in the 60s and the 70s, when first he was a small enough investor that he wasn't imitated every second of every day like he is today. He had far less money to invest, so you had never price impact, and he could do things under the radar. And this was in a market where lots of companies were under the radar. You didn't have the kind of wall-to-wall coverage of stocks you have today. What worked for Buffett in the 60s and the 70s might not work for you today. Now, so when you look at the most successful investors, remember their success is a product of what they brought to the table, which was substantial, the times they were in, and the markets they were with. And if you take one of those three out, you can try to replicate everything they do and have nothing to show for it.
I think it's such an important lesson, and I'm really glad you talked about that because we spend so much time studying what they've done, and some people even like to take the approach of just copying what they buy, but our outcome could be vastly different. And like you just talked about, what worked for them back then, things are different now. And so we can learn certain things about maybe how they valued the businesses, and there's important lessons to take away. But I think today you have to really think about what philosophy fits you.
Right.
And so one thing I wanted to ask you, I interviewed David Rubenstein a while ago, and he talked about super investors and how they became great, and they were really a master at their craft. They were amazing at one thing and they stuck to that. And so I guess I'm just wondering, do you think that applies to investing today? And do you think in order to be successful in investing and be stock pickers, we need to become a specialist in one area and just stick to that?
I don't think so. I mean, I think specialists are doomed for failure in this market because they have tunnel vision and they're incapable of looking past their specialty. In fact, I think you have a much better shot of succeeding in investing if you can see the big picture. Big picture in terms of looking at what happens across companies, not just in your market, but geographically across markets, not just stock markets, but bond markets and crypto markets. Because I think having that perspective is what's going to give you an advantage. You get into the specialist game, you're going to be playing against other specialists, and you're all going to lose. There's no way any of you is walking out of this a winner. So I think first, be a generalist, not a specialist. Second, find a philosophy that fits you, that you truly believe in. And that's critical, you keep switching philosophies because they don't work for you. You don't have a philosophy. And most portfolio managers, in my view, don't have a core philosophy. One of the things that these super investors have is they have a core philosophy. A philosophy they go back to, not a strategy. Buying low PE ratio stocks is not a philosophy. That's a strategy. You need a philosophy which involves where you think markets make mistakes, why you think they make those mistakes, and what will cause those mistakes to get corrected. Those are three critical.
So I think I'll just want to stop here. I think this is basically the three questions that you have to find an answer to your philosophy, and which also explains why I think it's the most important 10 to 12 minute video of your entire life. Because from an investing perspective, like I said, there are many different ways that you can go about investing. Growth investing, value investing, deep value. I don't know what other strategies out there. And it all comes back down to these three questions. So where is the market making this mistake? Why is it making a mistake? And what will cause the mistake to correct itself? Because at the end of the day, let's not forget that by investing into a particular company, you are saying that, oh, I think the market is mispricing this particular stock. But they can continue staying mispriced for the next 5, 10, 15 years, and you don't get to enjoy the upside. So from this perspective alone, I think finding the mistake itself, it's very simple because every day in the markets, there are a lot of noises. I think the key criteria here is in order for you to earn that premium or to earn that alpha, the mistake has to be corrected. Whether it's corrected within 6 months, in a year, 5 years, 10 years, nobody knows. So that's ultimately how you go about thinking about your investment philosophy. And maybe just to share mine, like a very quick breakdown, essentially, I like to buy stocks that are beaten down, which is why I think back a year ago, a lot of people are calling me like Chee likes to catch falling knives, or falling knife is my middle name. Because I do like to look at stocks that go down like a large extent, 50, 60, 70%. You have Alibaba, you have Meta, you have Amazon, you can add companies down that list. So this becomes a core fundamental investment philosophy of mine. I like to identify this kind of opportunities and I like to bet against the market, thinking that the market is wrong in terms of their assessment on why these companies don't deserve to be beaten down by such a large extent. So there are some that worked out, for example, Meta. On the flip side, there are some that haven't worked out yet, like Alibaba. Alibaba have been back holding for 2 years now. But that is my core thesis or my core understanding why I think the market is wrong in terms of their judgment and their how they determine the value. Whether I'm right or wrong, I think only time will tell. But I kind of do have time on my side, so I'm not that worried about it. So I think back to your own personal investment philosophy, how are you investing and why do you think the market will correct this mistake? So just some quick thoughts about it and just allow Damodaran to complete his logic and his argument.
Because every investment philosophy is built on a premise that markets make mistakes in certain scenarios. Be clear about what those scenarios are in your mind. And the reason they make those mistakes can be behavioral because people have psychological quirks that make them make those mistakes. It could be data driven because in certain scenarios the data might not be available. But you also need some part of your philosophy that explains why those mistakes will get corrected. Because remember, you don't make money by finding mistakes. You make money from those mistakes getting corrected.
I think just to jump in here as well, to really talk about whether is it qualitative, quantitative or whatnot, I like to play with, or I like to capitalize on the market's emotions. I like it when people say that, oh, this business is dying, there's no more hope, geopolitics is going to happen, oh, I don't know, Chairman Xi is not going to work with US, they're going to invade Taiwan. It just... There's this entire journey of emotional gyration. It gets people rah-rah, we can't touch, China is uninvestable. Think about it. Just go back the scenario over the last 1 or 2 years. That's exactly what has been playing out. And I love this kind of people causing a mainstream or conventional view and saying that, oh, this entire business or this whole basket of things are just untouchable. So that's when I like to come in with a contrarian thinking and to really assess the judgment and the analysis here. And of course, it doesn't mean that I'm going to buy all cheap stocks. I haven't been buying PayPal. I didn't buy Intel. There are a lot of these quote-unquote famous value investing plays because the stock is objectively cheap. But you don't see me plowing capital just because I think that the stock is objectively cheap. Because let's not forget on the second part of this equation, the market needs to correct the mistake. So if there is a deterioration in terms of the brand equity, in terms of the moat and stuff like that, there is a cause for concern, and which is why I don't necessarily touch all air quotes cheap stock. So yeah, I hope I managed to succinctly explain my type of thinking in terms of how I look at investments, but that's just my own opinion, and I'll just let Damodaran finish his piece.
So when I talk about investment philosophy, I'm not talking about do you buy low PE stocks. I'm talking about your thinking about markets and investing that's leading you to buy low PE stocks. Because the difference is you buy low PE stocks and they make money, great for you. But that might not work 10 years from now. If you have a core philosophy, you can go back to it and find a different strategy that works. So one of the things that you will find that great investors have in common is they each have a core philosophy that they go back to. Whether you're talking about George Soros or Warren Buffett, very different investors. Each has a philosophy that works for them, very different views on markets, but they both found a way to make it work. But there's another ingredient that we don't like to talk about because it makes us uncomfortable, which is a big part of being a great investor is being lucky. And let's face it, you could run an experiment, you could go back in time and restart the Warren Buffett experiment. But in the first 3 years of investing, it turns out that the timing was off. The markets were off, he didn't make money. The people in his partnership withdrew all their money. We'd be writing a very different history today, right? Let's not underestimate the role that luck plays in the investing game. Because it should make us all and that's why I think the very best investors, if you ask them, why did you succeed, will attribute a big chunk of their success to being lucky, being at the right place at the right time.
Yeah, so I think that pretty much sums up the entire idea of your own core investment philosophy. Hope you guys enjoyed the discussion. I pretty much love this man a lot. I'll leave the link to his YouTube in the description box down below. For those of you who are really, really free and have nothing better to do, or really have time to sit through the entire theoretical discussions around finance and valuations, I do highly recommend his videos. But I think it's like a 16, 18, 20 part series, and every video, every episode is more than 1 hour long. So yeah, for those of you who really have that passion to really understand more and didn't went through that official university education, I do highly recommend his stuff. So with that, I hope to see you in the next video, but more importantly, I'll see you on the moon. Goodbye.